Invest wisely and grow your money, no matter what happens to the economy. I'm going to show you 2 ways to do that in this video. Hey everyone, I'm Rose and welcome back to my channel, the #1 place for financial education, empowerment, and inspiration. Today we're going to talk about recession-proof investing. I know it can be scary to get started investing given all of these financial news headlines predicting doom and gloom. And that's why I wanted to make this video so I can educate you a little bit about how you should approach your own investing ahead of a market crash. Yes, there are some indicators that point to how some aspects of the economy are shaky right now and how it looks similar to the economy before the 2000 dot-com crash and the 2008 financial crisis. And I do talk about all that in this video right here. However, the problem is that when you avoid investing completely because you're afraid of experiencing a downturn, then you also miss out on a lot of returns. In fact, if you had listened to all the doom and gloom headlines that you see in the news, then you would have missed out big time. I mean, just check out all these articles. People were predicting catastrophic stock market crashes ever since 2013. They were predicting it in 2014, 2016, 2018. I mean, every year there's literally someone who is predicting a stock market crash. And you know what? Meanwhile, the S&P 500 between 2013 and now has almost doubled. Can you imagine how much it would suck to have sat in cash all those years just because you read something in the news? That's why not investing at all because you're expecting a recession sometime soon isn't a good idea either. Yes, we need to be mindful of cycles and whatnot, but in general, it's always better to be invested than to not be invested. Cash is the absolute worst place to be in long term. It doesn't grow and only loses purchasing power from inflation over time, and that's a guarantee. That being said, it's important to have a good investing strategy. Now, any sort of market timing investing strategy is a really dicey way to invest because as you saw with all those articles, it's really hard to call the exact timing of a recession. Sure, if you can do it well all the time, then yeah, you'll get rich really fast. In which case, I want to be your friend and you should totally share your money with me. But the average person can't time the market. Get lucky once or twice, sure. But investing by trying to predict where the economy is headed is not a reliable strategy. And look, I'm speaking from personal experience. Back in 2015, I started reading a bunch of articles about a coming US economic collapse and how the US dollar was going to lose all of its value and all this crazy stuff. And so I moved a lot of my money out of stocks and bought a bunch of gold. And about a year or two later, I essentially broke even on that gold investment. And I actually missed out on a lot of stock market growth. So all in all, that was a really humbling experience for me because I pride myself on being pretty smart and well informed, but I was totally wrong about what I thought was gonna do well. I speak from personal experience. It's really hard to time the market. No matter how convinced you are that you're gonna be right, it's just impossible to know because the markets are so large and dynamic. That's why I'm convinced that these 2 strategies that I'm going to share with you in this video are the best way to go. Both of these strategies, rather than relying on market timing, in other words, predicting correctly when the recession is going to happen, instead, these 2 strategies rely on timeless investing principles. Timeless principles that are going to make you money in all markets, regardless of a recession or no recession. So the first strategy that I want to talk to you about is Ray Dalio's all-weather portfolio. Ray Dalio is a master investor. He's the founder of Bridgewater Associates, and he is regarded by many to be one of the best investors in the world. In an interview he did with Tony Robbins in the book Money, Master the Game, Ray Dalio explains that the best way to invest is by creating a balanced portfolio that is designed to succeed in any economic environment, even during recessions. His reasoning is that there's only 4 things that move the price of assets. There's inflation, and then the opposite of inflation, deflation. There's economic growth, and then the opposite of that, which is declining economic growth. And depending on what economic season we're in, there will be an asset class that is performing better than all the others. For example, stocks. They do well during times of rising economic growth and moderate inflation. Bonds, they do well during times of declining economic growth and deflation. And gold does well during times of hyperinflation or really out of control inflation. Kind of like I was explaining with my own personal story, if I had been right and gold was the asset class to be in, I would have done really well. But the problem is it's actually hard to know when these economic seasons will hit, or even if they'll hit, and when they do, how long they're gonna last. So right now we're in a season of strong rising economic growth and moderate inflation, so stocks are doing really well. And if you're all in stocks right now, you're probably doing really well. However, we don't know how long this season is gonna last. It could be 2 more months or even 2 more years. And then when that season ends, we don't know what season is gonna be next. And therefore, we don't know which asset class to be invested in. So, going back to the all-weather portfolio, this portfolio is designed to have the ideal ratio of gold, commodities, stocks, and bonds so that it's gonna make money regardless of which economic season we're in. The all-weather portfolio has earned an average of 9.72% in the 30-year period between 1984 and 2013. And what's crazy about the all-weather portfolio is that it only had 4 down years in all of those 30 years. Its worst year was in 2008, and it lost 3.93%. However, we all know what happened in 2008. The S&P 500 actually lost 37%. A loss of 3.93% for the all-weather portfolio is peanuts compared to what most people experienced during that crisis. So I would say the all-weather portfolio is pretty bulletproof and about as recession-proof as it gets. Now here's how to create your own all-weather portfolio. The proportions that Ray Dalio recommends of each asset class is the following: 30% in stocks, 40% in long-term treasury bonds, 15% in intermediate-term treasury bonds, 7.5% in gold, and 7.5% in commodities. Now, the way you can do this for yourself is either invest in a combination of ETFs or mutual funds according to these percentages. So for the stock portion, you can invest in, for example, Vanguard's Total Stock Market ETF, VTI, or if you prefer mutual funds, which is my personal preference, you could do Vanguard's Total Stock Market Mutual Fund, which trades under the stock ticker VTSAX. And for the long-term treasury allocation of 40%, you could do the iShares 20-plus year treasury ETF, TLT, or you can do Vanguard's version of the long-term treasury bonds, their mutual fund, VUSTX. And for the 15% allocation to intermediate treasury bonds, you could do the iShares 7 to 10 year treasury ETF, which also trades under the stock ticker IEF, or you can do Vanguard's mutual fund, VFIUX. And then for the gold allocation of 7.5%, the Spider Gold Shares ETF, or GLD, is a good one. And for the commodities allocation, you can try the PowerShares DB Commodity Index Tracking Fund, which trades under the ticker symbol DBC. And there aren't any mutual fund versions of these gold and commodity ETFs, but that's going to be fine. So all in all, the all-weather portfolio is what he calls a portfolio that will do well in 2022, even though we can't possibly know what the world would look like in 2022. That is the ultimate recession-proof portfolio, and it's really easy to implement. The second recession-proof investing strategy that I want to talk to you about is investing in individual stocks, Warren Buffett style. This is a type of investing, also known as value investing, where you only buy stocks at a margin of safety price. A margin of safety price is when you buy a stock at a price that's so low that you basically are getting it at a huge discount. And that discount compared to the fundamentals of the company that you're buying means that you got the stock basically on sale. Essentially, it's when the stock is worth this, but you're actually paying this. Just because a stock is trading at a market price of, I don't know, $100 doesn't mean that it's actually worth $100. The intrinsic value of a stock always comes back to the cash flow of the company, the earnings of the company, back to the fundamentals. And sometimes the stock price gets overvalued and sometimes it gets undervalued. So the key with Warren Buffett's investing strategy is to make the market's wild emotional price fluctuations work in your favor so that you can scoop up great stocks when they're on sale. As Warren Buffett says, price is what you pay, but value is what you get. So what we're looking to do is buy stocks at a price that is lower than its value. The idea here is that if you pay less for a stock than what it's actually worth, in other words, at a margin of safety price, then it's impossible to lose money because you already paid so little for the stock. Now, if you own these stocks during a recession, yes, you'll probably experience some temporary paper losses since everyone is pessimistic and stock prices are probably declining across the board. But eventually, the idea is that the price corrects back to its intrinsic value because you bought something at less than its worth, and eventually that price will converge back to what it's really worth. If done right, as a value investor, you eventually come back out on top, always, because irrationally depressed prices, they always correct back to intrinsic value. For this type of investing strategy, you also want to assess fundamentals, such as the company's cash flow and its ability to service its debt with its cash flow. Because as long as the company's cash flow is strong enough to get it through a recession without defaulting on its debt and having to go into bankruptcy, then you know that company's going to stay in business and weather the recession and get back to business as usual. The opposite of this type of investing is, for example, during the dot-com bubble, there were a bunch of these new age technology webs, like internet companies that basically had an intrinsic value of zero because they weren't making any money yet. They were actually not profitable. And those stock prices were at these crazy high valuations, and people were just paying a ton of money for these stocks that didn't have any fundamental intrinsic value. And so when the dot-com bubble burst, those investors lost 100% of their money because they had no margin of safety and in fact did the opposite, which is just paying way more than what those stocks were actually worth. Examples of these were the pets.com stock. There was a company called etoys.com. Neither of these companies had any prospects for making profit anytime soon, yet investors were happy to pay like ridiculous prices for these stocks. So inevitably they lost all their money. There's a lot more to value investing because first of all, you have to know how to do a little bit of number crunching to calculate a stock's intrinsic value. And I do talk a little more about that in this video. So make sure to check it out. And I'll also link to a couple books that I recommend if you're interested in learning more about this type of strategy. The bottom line is focus on what you can control. You can't control the economy or when a recession happens, and you can't time it. The best you can do is to have a recession-proof investing strategy. A strategy that's based on timeless investing principles, such as having a balanced portfolio that does well in any economic season, Ray Dalio's all-weather portfolio, or doing it the Warren Buffett way and investing in stocks of great companies at a margin of safety price. Some other things you can do is to have an emergency fund in advance of a recession, because having a bit of cash cushion ensures that you won't have to dip into your investments during a downturn and sell your stocks at the worst possible time. It also gives you a measure of psychological comfort so that you'll be more comfortable investing your extra money knowing that you have a bit of cash cushion to fall back on. So there are recession-proof investing strategies as taught by experts like Ray Dalio and Warren Buffett, and they're proven to get you through recessions and ultimately leave you with a lot more money than you started with. Whether you are expecting a recession or not, I would say find a great strategy and get invested. Did you like this video? If you thought it helped you learn more about investing, please share it with your friends and subscribe to my channel and give it a like, because it really helps this channel out. If you have any questions at all about what I talked about in this video, feel free to drop it in the comments below or DM me on Instagram at Investing with Rose. Always remember to go after your dreams unapologetically and to live life on your terms. Cheers.